There are three little numbers that decide whether you get a home loan, a car loan, even some jobs. Three digits between 300 and 900. Your CIBIL score. And here's the scary part. Most people have no idea how it's calculated. They think it's random, it's not. There's a clear recipe behind it. And once you know the recipe, you can control your score instead of fearing it. In the next few minutes, I will show you exactly how your CIBIL score is built, especially from your credit cards, and the simple moves that push it up in plain English. Let's go. First, what is it? CIBIL is a credit bureau, basically a company that keeps a report card of how you handle borrowed money. Every time you use a credit card or pay a loan EMI, your bank reports it to them. They take all that behavior and crunch it into one number from 300 to 900. The higher, the better. Above 750 is considered good. That's the zone mark where banks happily approve you and give better interest rates. Below 650 and lenders get nervous. Think of it as your financial trust score. You earn it over time and you can lose it fast. Now, the main event. Your score is built from four ingredients, and this is key. They are not equal. Some matter way more than others. Roughly speaking, payment history is the biggest, about 30%. Did you pay on time? Credit utilization. How much of your limit you use? About 25%. The age and mix of your credit? About 25%. And other things like new applications? About 20%. Quick honest note. CIBIL's exact formula is secret, so treat these percentages as close estimates, not gospel. But the order is what matters, and paying on time is king. Ingredient 1. Payment history. This is the single most powerful factor, so listen closely. It simply asks, do you pay your credit bill and EMIs on time? Every time one late payment isn't just a small ding. A payment that goes 30 days overdue can knock your score down by around 10 points in the next update. And a strong score actually falls harder. Worse, defaults and settles. Marks leave scars that take a year or two of clean behavior to heal. So, rule number one, above everything else, never miss a due date. The easiest fix in all of personal finance. Set up autopay for at least the minimum amount. That one toggle protects the biggest chunk of your score. Ingredient 2. Credit utilization. This is the one most people get wrong with credit cards. Utilization just means of your total credit limit. How much are you using? If your credit limit is 1 lakh and your outstanding is 30,000, that's 30% utilization. The golden rule, keep it under 30%. Below that looks disciplined. Go above 50 to 60% regularly. And even if you pay in full, it signals you are leaning on credit and your score takes a hit. Here is the clever trick. You can lower your utilization without spending less. Just ask your bank to raise your credit limit. Same spending, bigger limit, lower percentage, score goes up. Many banks do this without a hard inquiry. Second trick, don't wait for the bill. If you have spent a lot, pay part of it before the statement generates, so the reported number is low. Ingredient 3. The age and mix of your credit. This one rewards patience. Age means how long your accounts have been open. An old credit card you have had it for years is a quietly powerful asset. It shows a long, stable track record, which leads to a mistake people make all the time, closing their oldest card because they don't use it. Don't. Closing it can chop down your average account age and actually drop your score. Keep it alive with one small purchase a year. Mix means variety. Having both a card and, say, a loan shows you can handle different types of credit. You don't need to chase this. Just know that one healthy old card plus responsible borrowing will sit naturally. Ingredient 4: New credit and inquiries. This is about looking desperate. Every time you apply for a new card or loan, the bank checks your report. That's called a hard inquiry. One is harmless, but 5 applications in 2 months screams this person urgently needs money, and your score dips. So don't apply for many cards at once. Space out applications and avoid the habit of grabbing every pre-approved offer that lands in your inbox. One gentle reminder: checking your own score does not hurt it. That's a soft inquiry. So check yours regularly, free, without fear. Okay, let's turn all that into a simple action plan. 5 moves in order of power. 1. Turn on autopay so you never miss a deal. Biggest factor, easiest fix. 2. Keep your card usage under 30% or raise your limit to get there. 3. Keep your oldest card open even if barely used. 4. Don't apply for many cards at once. 5. Check your own CIBIL report a couple of times a year. It's free and you will catch errors that secretly drag your score down. Do these and your score doesn't just sit there, it climbs quietly month after month. Before we finish, 3 quick myths to kill. Myth 1. Checking your score lowers it. False. Checking your own is always safe. Myth 2. Having a credit card is bad for your score. Wrong. Used well, a card is one of the best tools to build a score. Myth 3. A higher income means higher score. No. CIBIL doesn't even see your salary directly. It only cares how you handle credit. A person earning 30,000 with great habits can easily beat someone earning 3 lakh who pays late. Let's lock it in. Your CIBIL score is a recipe of 4 ingredients. Payment history is king. Then how much of your limit you use. Then the age and mix of your credit. Then how often you apply for new credit. Control those and you control the 3 numbers that quietly decide your financial life. If this made CIBIL finally makes sense, subscribe. I explain the confusing money stuff in plain English every week, and tell me the comments. What's the most confusing funny topic you want me to break down next? See you there.